Thermax Limited, an innovative energy giant with a strong reputation and bright prospects. An integrated innovative product portfolio focusing on comprehensive engineering solutions, rising revenue and a strong presence in the overseas market. 4 product segments led by industrial products, leader in revenue and profits. Industrial products, significantly high contribution to the profitability pool, dominates the aggregate bottom line of the company. The segment of industrial products, promising and positive in sequential growth in revenue and margins on a quarterly basis, evident from a rising EBIT percentage on a TTM basis. The volume on EBIT showing an annual growth of whopping 33% reflects the quality of competitive edge possessed by the company. Industrial infra, the second largest revenue stream. Industrial infra moves hand in hand with industrial products in revenue but is a laggard in profitability for reasons specific to its constituents, industrial infra and bio-CNG. While revenue of industrial infra grows marginally at about 5.8%, its profitability just collapses, falling to a level half that of the corresponding previous year. Rising costs not supported by price revisions and unforeseen cost overruns, particularly in bio-CNG, are eating up profits, the segment by its very nature yielding lower profits. Green solutions is evolving and going with the global focus on renewable energy. Green solutions is yet to make profits. It's marked by high technology intervention costs but shaping up as a very promising business segment. Specialty chemicals, small but significant in profitability and growth appetite. Specialty chemicals, a small part of the mix but exceptionally profitable, ranks in profits only next to industrial products. The specialty segment has shown a phenomenal growth in its revenue during the period, but as regards the profits, there has been a marginal fall during the year, and a look at the EBIT percentage suggests descending incline over last 3 quarters. But the premium margin percentage reflects the pricing power and the exceptional strength for the company as a whole. On a TTM basis, EBITDA and EBITDA percentage are showing a positive growth, although the growth is quite marginal, and if we compare the data points for the last 6 years, the EBITDA percentage has improved sequentially from 8.6% to 8.7%, but the volume growth of EBITDA has been disappointing, falling from 33% of previous year to 14% during the current year. Volume growth falling is compensated by an improvement in the margin percentage. On a CAGR basis, the growth in earnings before interest, tax and depreciation is indicating something of concern, as the 2-year CAGR has fallen as compared to 3-year CAGR, and so also the recent year has shown a poor growth. When it comes to NPAT, the growth has been quite impressive on a 5-year basis, 3-year basis, and of course on a 2-year basis on a lower scale. But the latest year is a disappointment with negative growth, largely because of the 75 crore exceptional income reported in FY23-24. Undeniably, there is a pressure on margins. The company has a strong P.Ex program, particularly during the last 3 years with massive investment, payout ratio averaging about 25% during the recent 3 years, a consistent dividend record, effective working capital management with control of receivables and inventories, along with the huge operational surplus, has facilitated exceptional liquidity, attractive return on equity at 13.4% despite a fall in NPAT. Of course, return on equity is lower than the peak of 15.5% reported during FY23-24. Very positive is the growth in the size of the balance sheet with a 5-year CAGR in excess of 15%. But in comparison, company's net worth could grow only at a 5-year CAGR of around 10%, thereby forcing the company to use external funds to the balance extent. And that is where we find net worth as a percentage of total assets has shrunk from 50% to 41.1%. Company has a cash balance as a percentage of assets at a decent 9.6%. A strong financial profile, good liquidity, and minimal debt explains the financial strength of Thermax. The company's current market capitalization at around 44,000 crores. With the fall in NPAT for FY25, the current price earning multiple appears around 71. On a 12-month timeline, return to investor has been negative at minus 25%. With the company's fortunes expected to hit better heights in FY26, it is likely that the prices might regain their position of strength. A look at the daily chart of Thermax over last 12 months. 52-week high reached in July. The share moves into bearish zone in February, crashes, loses 50% of its peak and reaches 52-week low in February 25, consolidates for over 4 months and is up 27% from 52-week low, positioning itself around a Fibonacci level which is relatively positive for the company. Continued focus on innovative solutions in all segments has helped growth with profitability. Revenue growth and geographical spread reflect successful market growth. Prompt execution and replenishment of order book is an exceptional strength. Prospects brighten with government-supported initiatives in infra, environment and green energy. Business cyclicality in the client industry of engineering and capital goods is affecting fortunes negatively. Intense competition in various business components makes the scenario more challenging and equally stressful on margins. Hope you found this video on Thermax to your liking. I am Vittal Prabhu with the fortnightly video on Stock Learning Simplified. Videos with similar content may be accessed at our info card. We eagerly await your valuable feedback. If you are new to the channel, may kindly subscribe and press the bell icon for timely intimation on our forthcoming videos. For your valuable time and kind support, highly obliged. This video is for purposes of information, education and awareness only. This is not meant to be a solicitation or recommendation to buy, sell or hold securities. Wherever applicable, kindly seek the advice of a competent professional before taking action of any kind.